Hey everyone! Today we're diving into the world of finance, but don't worry, we'll keep it simple. Finance can seem intimidating, but understanding a few key concepts can make a big difference in how you see the world of money. Ever heard of a repo rate? It sounds complicated, but it's really not. In fact, it's a term that plays a crucial role in how money flows in the economy. Imagine your friend needs some quick cash and you lend it to them with their phone as security. This is a simple example of how borrowing and lending work in everyday life. They promise to pay you back with a little interest, and you give their phone back. This interest is essentially the cost of borrowing money. That's kind of what the repo rate is, just on a much larger scale. Instead of friends, think of banks and the central bank of a country. The Reserve Bank of India, or RBI, our financial superhero, lends money to banks when they need it. This helps banks manage their short-term financial needs. The repo rate is the interest rate the RBI charges on these loans. It's like the RBI saying, "Sure, I'll lend you money, but here's the cost." Think of it as the price banks pay to borrow money from the RBI. This rate influences how much banks charge us when we borrow money from them. But why should you care about this? Well, the repo rate affects everything from loan interest rates to the cost of goods and services. This little rate has a big impact on our economy and your wallet. So the next time you hear about the repo rate, you'll know it's more than just a financial buzzword. In a surprising move on April 6, 2025, the RBI decided to cut the repo rate by 25 basis points. That means the rate went down from, say, 6.5% to 6.25%. Why did they do this? Well, the RBI is like a doctor for the economy, always checking its pulse. Right now, they're seeing some warning signs, slowing economic growth and global uncertainty due to, let's say, political instability or a trade war. Lowering the repo rate is like giving the economy a vitamin boost. It encourages banks to borrow more money at a cheaper rate. This brings us to the next point. How does this rate cut actually affect us? Remember how the repo rate affects how much banks pay to borrow money? It's a key tool the Reserve Bank of India uses to control the economy. By adjusting this rate, the RBI influences how much money flows through the financial system. Well, when the RBI lowers the repo rate, banks have more money to lend. This means they can borrow funds from the RBI at a cheaper rate, which encourages them to pass on the benefits to their customers. And when banks have more money to lend, they usually offer loans at lower interest rates. This makes borrowing more affordable for individuals and businesses, boosting economic activity. This is great news if you're thinking of buying a house or a car. Lower interest rates can make big-ticket purchases more accessible, helping you achieve your dreams sooner. Your EMIs could get smaller, putting more money back in your pocket. This extra cash can be used for savings, investments, or even day-to-day expenses, giving you more financial flexibility. But it's not all sunshine and rainbows. A lower repo rate can have some downsides too, especially for those who rely on interest income. Lower repo rates can also mean lower interest rates on your savings accounts and fixed deposits. This can impact retirees and others who depend on these for steady income. So, while borrowers celebrate, depositors might feel a slight pinch. It's a delicate balance that affects different groups in different ways. But remember, the RBI carefully considers all these factors before making a move. Their decisions are aimed at maintaining economic stability and fostering growth. They want what's best for the overall economy, ensuring that both borrowers and savers can thrive in a balanced financial ecosystem. Section 4. India's Economic Future, the Repo Rate Crystal Ball. In this section, we delve into the potential ripple effects of the recent repo rate cut and what it could mean for India's economy in the near and long term. Now let's gaze into the crystal ball and see how this repo rate cut might shape India's economic future. Repo rates, as you know, are a key tool in monetary policy, influencing borrowing costs and liquidity in the market. Experts predict that this move could boost economic growth in the coming years. By making loans cheaper, businesses and individuals are more likely to borrow and spend, which can stimulate economic activity. The International Monetary Fund projects India's GDP to grow at, say, 7% in 2026. This optimistic outlook is based on the assumption that the rate cut will encourage investment and consumption. Lower borrowing costs could encourage businesses to invest more, leading to more jobs and a stronger economy. This could be particularly beneficial for sectors like manufacturing and infrastructure, which are key drivers of growth. Of course, many factors influence economic growth, and the repo rate is just one piece of the puzzle. Global economic conditions, government policies, and consumer confidence also play significant roles. Inflation is another big one. While lower rates can boost growth, they can also lead to higher inflation if not managed carefully. The Reserve Bank of India aims to keep inflation in check, and this recent rate cut could push inflation up slightly. However, the RBI remains vigilant and has tools to manage inflationary pressures. However, they're hoping it stays within the target range of 2 to 6%. Striking the right balance between growth and inflation is always a delicate act, but one that is crucial for long-term economic stability. Section 5. What's next? Navigating the repo rate rollercoaster. So, what can we expect in the future? Will the Reserve Bank of India cut the repo rate again? Or will they hit the brakes and raise it? Well, it's hard to say for sure. The RBI closely monitors the economy and makes decisions based on a variety of factors. But here's the good news. Understanding the repo rate empowers you. You can make informed financial decisions based on the current economic climate. So, stay informed, keep an eye on the RBI's announcements, and remember, knowledge is power.